Hey there, today on the Final Bar, we'll do our normal Friday routine of wrapping the week, focus on how the markets have evolved from last Friday to this Friday. Overall, there's been plenty of volatility this week with the S&P pulling back there into the afternoon, settling down just below the zero level. What does this mean for the overall trend? We're gonna look at the market trend model, talk about small caps actually doing just fine on Friday, the lowering VIX and everything in between. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets through the lens of technical analysis, behavioral finance, investor psychology, trying to make sense of the markets by analyzing price. As most of my mentors, if not all of them early in my career, reminded me, if you have one thing to pay attention to understand the dynamics of the market, to understand what investors are thinking, to understand when there is euphoria, desperation, panic, excitement, concern, all of that arguably is reflected in stock price. I remember John Murphy's book was the very first one I read on technical analysis of the financial markets. And he talked about it, really hit home, the idea of studying market history, the idea that prices move in trends and can capture the sort of underlying psychology of investors, and that there's value in looking at repetitive price patterns, that the market has memory, right? Price has meaning, price reflects information and how people are treating it. We try to capture all of that as we analyze the charts together at the end of every trading day. We have some great guests coming up this week. I was really happy talking with Katie Stockton from Fairlead Strategies yesterday. If you missed that, check it out on StockCharts TV on demand or on our YouTube channel. Coming up next week on Tuesday, the 25th, we have Louis Yanitz from WealthNet. Coming up on Wednesday, the 26th, we have Javed Mirza from Canaccord Genuity up in Toronto. And then two special events to let you know about next week, which are really going to be fun. First off, we have a new educational series called Chart School that's based off of the Chart School part of our website, which is very heavily used by a lot of new investors, a lot of investors looking to refresh on some of the rules of technical analysis and trading. We are bringing some of that Chart School content onto StockCharts TV. And our first series is going to be on idea generation, 5 different experts, all providing their scans that they use. How do they use the scan engine to identify equity ideas? You're going to have 5 different perspectives over 5 days. I'd encourage you to check those out. Also on Thursday, the 27th, I will be hosting the next episode of The Pitch. This is a stock picking showdown with 3 experts. I'll be moderating a conversation with Danielle Shea from Simpler Trading, Mary Ellen McGonigal from Mem Investment Edge, and also Aaron Swenlin from Decision Point. They're each going to bring 5 stock picks with them. We'll have them each present them, then discuss them as a group and see what sort of themes we can uncover. You will leave that event with a series of charts and tickers jotted down to dig into more deeply. So I hope you can join us on the 27th. Let's continue on to our market recap, our wrap the week segment. But I like to start with the poll that we asked recently. And this is a little bit tongue in cheek, but this actually came, the question was, which of the Uniteds performs best over the next 3 months? And this is actually based off of a chart that used to be in the Fidelity chart room years ago. My mentor, one of my predecessors, Bill Doan, had created it called the Generals, and it was General Electric, General Motors, General Re, and a bunch of others, and there was all stocks named General. It was like a great sort of alternative index for the overall industry or overall economy. So in that vein, I asked which of these 4 do you think is the best suited? United Airlines, United Parcel Service, United Healthcare, or Manchester United? Not surprisingly, only 6% of you went with Man U, and I'm a Tottenham Hotspur fan, so I will acknowledge that Man U certainly came in last in that one. It was actually a tie between UAL and UPS, and it's interesting. UPS is sort of a bellwether name, right? It's sort of the type of name that when that's doing well, when UPS is doing well, how bad can things be is sort of the way I've generally thought of it, UPS and FedEx obviously providing a lot of distribution for a lot of things. And we're certainly ordering now more than ever from home. It's interesting, UPS has had a pretty good run and stalled a bit just in the last couple of weeks, became extremely overbought on RSI above 80, now pulling back out of the overbought condition. Looking at the chart here, you compare that with something like UAL, which really has been underperforming, but not by much. It's been sort of a sideways performer here for a little while, pulling back as most things have here in the last month or so. Very interesting to see UAL and some of the other airlines putting in a higher low, just above $50 a share. And that's a real pivot point for UAL. So I get the argument for both of those. Not a lot of love for United Healthcare. Whoops, that's not the right one. UNH, I meant, sorry, UNH. And arguably out of those three, that's probably the best trend right now. So as a contrarian, I'm thinking United Healthcare might be the kicker there. Let's continue on with our Wrap of the Week segment. Again, this is our opportunity to take a step back and look at how the markets have evolved from last Friday to this Friday. We're going to start with the weekly trajectory. We'll update just on today's markets and how Friday finished off, and then we'll look at the Mindful Investor Live chart list and go through as many of those as we can just to sort of reset on the big picture environment going into the weekend. So overall, this is how things played out, and I don't have labels on here, sorry for that, but if you follow my mouse and my voice, I'll point you through where things are. So here's the S&P basically closing down about 0.4% for the week. So this is from last Friday to where we're at right now. Only two things underperformed the S&P. Small caps just a little bit lower, around down 0.5%. And then the biggest or the weakest out of all of them is crude oil here, down about 2.3%. Everything else outperformed the S&P this week by a very narrow margin. The dollar, which was only down about 0.3%, that's here in green, and we're using the UUP for that. Everything else was up on the week. Small caps, the NASDAQ 100 up 0.2%. In orange, we have emerging markets up 0.4%. Also up 0.4% is bond prices using the TLT. And then the biggest gainer out of that group of assets is gold, up almost 2%. It was very interesting talking with Katie Stockton yesterday, sort of a bullish take on gold, which I agree with. If you've been following what we've been doing on the show, we've talked about the rise in hard assets. We've talked about the benefits of gold sort of as a safe haven. And while it not always has been sort of a safe haven, if you have inflation concerns bubbling up, most likely gold would start to show some promise. And I think that's what we're seeing here. So interesting run in seeing that at the top of the list. Adding Bitcoin to the mix, we put that on here. That's here in blue, down 28%. Obviously continuing to weaken here. And overall, when you had that big move lower, we'll jump there very quickly before we continue on. Right, Bitcoin had a huge distribution down to 30,000, an immediate left turn up to 42,000. And I went on Bloomberg Television and elsewhere, was asked in a lot of media outlets about Bitcoin. And I know, looking at the volatility and the price moves, the severe price moves, has changed, 10,000 points in one day. That's a pretty significant move in any asset. Having said that, right back in distribution mode. And so it is fairly reasonable. This is what I would definitely characterize as a dead cat bounce. And if you look at the hourly chart, by the way, it makes a lot more sense because you can see how it fluctuates off of the lows and kind of comes back. It is absolutely expected, I would argue, after a huge down day like you saw on Wednesday, to have a big reaction move back to the upside. That's why you call it a dead cat bounce. Even though overall the trend is still down, it's reasonable after a huge puking out, and I'm sorry I don't have a better way, a huge distribution is probably a better way, but that's how I usually call it. After we've just dumped out all of the negativity comes out, not unreasonable that some people buy in on that big move down and expect a reversion back to the mean at the very least. We bounced back to that 42,000 level. I put a video on my own YouTube channel called Market Misbehavior a couple of days ago, focusing on Fibonacci retracements, focusing on these two shaded areas. And I'm not surprised to see we came back to 42,000, which is a Fibonacci level. That's also the highs from January. And that is where in the last 24 hours, we revert back to the downside and now just below 36,000. So if you missed that, maybe check out that video for a little more color on how to make sense of this range the Bitcoin is in. But I would see the movement lower in cryptocurrencies overall as the market in distribution mode and a very speculative part of the market in distribution mode. Let's focus just a little bit on today's action, and then we'll get to the long-term picture using the Mindful Investor live chart list. As I mentioned, the S&P essentially flat, just down a little bit below zero. The NASDAQ and the NASDAQ composite down about 0.5%, 0.6%, 6%. Mid caps and small caps are actually up a little bit, which is good to see. A little bounce higher in the afternoon session, and the VIX is nearing 20 again from above. Looking at some other asset classes, interest rates are actually a lot lower earlier, but came to finish strong around 163 on the 10-year bond. Prices up just a little bit, and the dollar up about 1/3% using the UUP today. Gold finished flat, and it was lower for much of the day, but actually rallied to close where it did. Silver was actually a little weaker. Energy overall okay, with oil prices up about 2.8%, and energy was about flat for the day using the XLE. Here's cryptocurrencies, and again, if you thought yesterday was an all clear signal, hopefully you got the caution in my voice that I think that is sort of the beginning of something deeper. And I think you heard Katie Stockton say a very similar thing. You don't have a huge distribution like you did 2 days ago, and then have the rally out of the lows like you did yesterday off of the 30,000 level, and not expect at least a retest of those lows, or at least another move down. Because what happens is it's a very behavioral, psychological thing. You have the huge distribution. Someone starts deciding, people run out of that group of buyers that are dumping it. All of a sudden that exhausts, and you have people coming in, sort of the value mentality, buying in and thinking you finally get Bitcoin at a half off sale and you can buy it for 30,000. That pushes the price right back up, but eventually it settles more into the long-term trend. And again, anyone that missed selling off on that first leg now all of a sudden can sell at a much better level when it goes from 30 up to 42,000. That puts it on the next leg lower. And this is that feedback loop that we talked about in the last couple of shows, right? The more things go down, the more that when it bounces up, people see that as an opportunity if they missed the first time, that they can keep distributing. And that pattern will tend to happen until you run out of negativity, until you run out of people that are basically panicked. Once that anxiety wears off, when people have dumped it enough that enough people are willing to come in and buy it at the lows, that's when something bottoms out. I don't see that happening just yet on cryptocurrencies, including Bitcoin. Very quickly on the sector basis today, financial is the best sector of them all, up 1%. When I was screening earlier this week for stocks making new swing highs, I found a lot in the financial sector, and particular areas that surprised me a little bit. Some of the global banks, things like RBC, ticker RY up in Canada, Itaú, which is a Brazilian bank, Bradesco. These are stocks you may not be familiar with if you look just at U.S. stocks, but these are U.S. traded listings, U.S. traded names that are domiciled elsewhere. Maybe worth looking for a scan for financial stocks making new swing highs, because I think you'll find some interesting ones. At the bottom of the list, the growth trade, technology, consumer discretionary, communication services, 1, 2, 3, right from the bottom. So interesting, after where growth felt like it was showing signs of life, especially yesterday, you get another distribution there going into the weekend. So not a great setup for next week. Let's finish off looking at the Mindful Investor live chart list, and we'll hit as many of these charts as we can. So I update my market trend model every Friday at the close. Now that we've gotten there, it went literally back and forth between bullish and bearish. And as things settled off, and as the S&P sagged down to close more on the weaker side today, it was just enough to trigger the short-term indicator and the medium-term indicator on my model to turn negative on both of them. Just slightly negative on both, but a confirmed negative on both. And so, from my opinion, that means you're in caution mode going into next week until you see a reversion higher, especially on this medium-term model, which is more of my main risk-on versus risk-off model for stocks. It's telling me to be more cautious and think more about defense, think more about risk tolerance, lines in the sand at which you would agree to exit positions, and less about looking for the next great home run that you can swing at. So interesting to see, after chopping around for quite a bit, it turned slightly negative. Next week is going to be interesting going to the daily chart, because it's a holiday week, right? It's not a shortened week, but it's the week leading up to the shorter Memorial Day holiday. And usually that week leading up to the holiday, especially going into Thursday and Friday, more often than not is usually sort of a flat to up period. That's usually lighter volume, but usually you trade higher going into a longer weekend. So it'll be interesting how that jives with some of the distribution that we're seeing so far today. Now, to be honest with you, when I'm looking at a lot of individual charts, I'm not struggling to find charts that look pretty good. I'm not struggling to find charts like Facebook that are holding up just fine. And the chart of the S&P is a perfect example of that. I'm seeing signs of distribution. I'm seeing signs of negativity. I'm seeing signs that concern me about the coming months for stocks, but what I'm not seeing is an index that's able to break down more than 5% or so. And if you look, the S&P finding support at its 50-day moving average, finding support at trend line support going back here to last October, is all very positive. You know, the concern I have for stocks is on the chart of the S&P, the chart of Apple, the chart of Facebook, the chart of some semiconductors, the chart of a lot of names. We're right, sort of, we've bounced off of a key support level. And a chart like Apple or a chart like the S&P in a day or two can look very, very negative. Look, think of what would happen next week if we break down through that trend line support, break down through the 50-day and follow through. All of a sudden, this looks like a market much more in distribution mode. And I think you could see very much a capitulation, an acceleration of selling enter in if people, you know, sort of a forced selling sort of mentality. If we start breaking support levels and people feel that, this could be a longer, more drawn out in price and or time sort of a pullback. But having said that, first thing needs to happen, you have to break support. So I would argue now is a perfect time, if you've not done so already, to review things that you are holding and focus on some of those lines in the sand. For the S&P, I think it's very clear around 4050 to 4100. That's trend line support, the 50-day moving average. Also now the swing low from May. We hold above 4050. Overall, the trend is not that bad. We start breaking that next week, I would be concerned. Breadth picture overall has remained fairly constructive. You're seeing some of these downturn this week, but the market's turning down as well. So it's not really a bearish divergence. We have the market going higher and the breadth is weakening. The breadth is sort of mirroring the overall market. It's not breaking down a lot yet. All of these are still above their 50-day moving averages at this point. So overall, remaining constructive. You have seen an evaporation of new highs. We talked about an expansion of new highs as being a very bullish configuration. That's what we had through the second week in May. We now have more of an evaporation of new highs. We have very few stocks making new highs. That shows you most things have sort of pulled back in the last week or two, much like the S&P has. We're sort of sitting a little bit below all-time highs, but again, we're just a little bit below all-time highs. So let's caution the negativity. Where there is some, I think that we'll have to leave it here, but this is one chart I'll certainly be following, and I'd encourage you to do the same on breadth, is the percent of stocks above their 50-day moving average. It pulled back from around 92% down to around 71%. It might be a little bit lower as we process that through today's close, but overall sitting right around 70%. And that's not bad. What's interesting is in the January pullback, where you pulled back about the same amount, we got down to around 40%, 45% of the S&P above their 50-day. This is as the S&P was testing its own. You can see this time, the S&P tested its 50-day, but only 70%, or actually 70% remain above. So there's a 20% difference between those two, 20 to 30% difference. So that shows you that the downturn has not been as widespread as it was back in January or in early March as well. This indicator holding 50% tends to be a really good differentiator between the actionable, buyable pullback like you saw in June of 2020, like you saw in January of 2021, and more of the drawn out, more painful pullbacks like you had in September of 2020, which ended up taking a couple months, August of 19, where you saw a 2-month period before we resolved to new highs. So that is an indicator as we start to think about potential pullback mode that I will be watching. We need to take a quick break and we'll be back opening the final bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the final bar. This is Dave Keller here at StockCharts.com. It is so good to have you join us every weekday after the close as we break down the activity of the markets using the power of stock charts, using data visualization to understand the dynamics of the market. It is a fascinating time to be following the charts, and I'm glad you're here along with us to do it together. We are here to help you. We're going to do a mailbag segment here in a moment. We would love to answer one of your questions on next week's mailbag segments. Shoot us an email with any questions that come up as you're using stock charts, as you're analyzing your own trades, your own markets, particular tickers, indicators, behavioral questions, whatever it is, we'll do our best to answer them on the air. Shoot us an email, thefinalbar@stockcharts.com. Look us up on Twitter @finalbarsctv, or on our YouTube channel. Just put a comment below the video that you're watching, and we would love to hear from you answer your question next week. Also, as a reminder, go to StockChartsTV.com. Use your email, set up a free account. You can watch immediately all of our great content from our fantastic hosts and guests. There's so much to learn, I think, from the great content on StockCharts TV. Go to StockChartsTV.com or any of the app stores. Just search for StockCharts TV on demand. Our next segment is opening the final bar mailbag. Let's hear what some of the questions that have come up in your own process here in the last couple of days. Question number one, on the S&P 500, would you consider the low on May 17th, this is from earlier this week, today's close, as a confirmation of a lower low May 12th compared to May 4th and a lower high May 14th compared to May 7th? Let's look at this chart. I'm going to zoom in just a little bit. So let's do like a 6-month chart so we can get a little more granular on what you're talking about. So here's the trajectory of the S&P, and you're saying, would you consider May 17th's close as a confirmation of a lower low May 12th compared to May 4th? Looking back, let's see, this way, May 12th to May 4th, and the lower high, right? So you're saying, is this sort of trend, lower highs and lower lows, are we now in a downtrend? So, for me, it's all about the time frame. When I talk about higher highs and higher lows, lower highs and lower lows, and I at some point should have t-shirts made with that because I say it so many times, but it's true. And I think a lot of times go back to the simple trend. So is this a new downtrend? So I have been calling it a tactical downtrend, a pullback. And for me, because based on the time frame, I think that's true. If you look back here at some of these pullbacks in January and February, you have a pattern of lower highs and lower lows. But on a longer time frame, if you're looking back at the last year, it certainly doesn't look like that, because then you're thinking of the structure a little more longer term, and you're seeing this is the low, the new high in February, the new swing low in March, the high, right? And so whether something is an uptrend or downtrend is based on your time frame. So I could see the argument that in the short term, in the tactical time frame, looking out a couple of days to a couple of weeks, yes, we're in a downtrend of lower highs and lower lows, especially on a closing basis. On the longer term time frame, this daily, this midterm time frame, I would argue we're still in an uptrend because we've been making higher highs and higher lows. I think breaking below the swing low from May on this time frame makes sense as confirming a new downtrend in that way, which we've not really gotten yet. If you look at a weekly chart, it doesn't look like you've had anything but higher highs and higher lows, because we haven't really made a new swing low yet on the weekly chart, right? So it all depends on your time frame. That's why my market trend model has 3 different time frames. It's very, I'm often asked, is this chart bullish or bearish? And my immediate follow-up question is, what's your time frame? Are you trying to trade out a couple years or a couple minutes or somewhere in between? And as a result, I think that's how I would answer that question. So on the time frame you're suggesting, which is looking at a couple weeks, absolutely. I think we're in a tactical downtrend. I think the fact that the short-term model in my work turned negative tells you there's been enough of a pullback. We've gotten below the 5-week EMA, and that's enough for me to trigger a tactical downtrend. That's about what it feels like. Question number 2, let's see. From what points and to what level do you use Fibonacci extensions for targets, i.e. which lows and highs, and what extension levels do you use? That's a really good question. So we have Fibonacci retracements and Fibonacci extensions in a couple different ways. This might be a good opportunity to show you StockCharts ACP. And if you haven't messed around with this, again, as with all of us, I think we all struggle to find time to do different things. It's been on my list to spend more time with ACP, and the more I do, the more I enjoy what I'm able to do with it. And I would tell you this. So, right, if you draw one of these lines, you can say this. If I'm starting at the high here and I go down to the lows, right? So I'm taking, all right, here's the high, here's the low, and I'm looking at Disney. Then, whoops, sorry about that. And then I take the whole thing and kind of stretch it up. You can see what I've done now is I've stretched the entire, or I've made a projection. I basically said, if this is 100% of the move from the low in March to the high in March of this year, and then if pulled back, what if we break above the new highs? What will be the next projections? And a lot of times you can use different measures of this, 138.2%, which would be in here, 161.8%. And we don't have all of these indicated here. These are just the major ones that people tend to use, starting with 161.8%. So that means if this is 100% of the move, we can project those levels even further. As you can tell by the fact that I don't bring them up often on the show, I don't use them a ton. And I tell you, I used to early in my career when I worked for hedge funds where they were focused on particular price levels and taking profits and betting on price swings. They used extensions and Fibonacci retracements and other speed lines and other sort of things to try to measure that. When I started working for big money managers, if something was in a big uptrend, they didn't care what line it hit. If the trend was up, they would want to continue to own it, and they would stop owning it when the trend stopped going up. So for me, cycles and projection levels are interesting and are anecdotal in my work. I would much rather focus on the trend. So how the price gets from where we're at to where they're going is where I would focus more of my time. That is a very basic way of how I would use it. And again, as a reminder, just like you would use retracements, once you have a low and a high and you project it down there's a whole set of circumstances that you can use to then project those levels after a stock breaks out. And you would use projection levels or extensions when a stock is making new highs, or also when it's making new lows and you want to project levels going even lower. Usually see it much more often in stocks making new all-time highs. And it's a way to say, if this is what it did from point A to point B, what about point C down the road a little bit? We'll be spending a little more time, by the way, it's on our development list to continue to improve the Fibonacci tools. And I'd love a little more flexibility with some of the extension choices that we have. It's all laid out. We're just gonna get it in the development queue and make it happen. Thanks so much for that question, by the way. Final question, and then we really have to wrap. Your guest earlier, Joe Rabel, talked about the ADX line. Can you tell a little bit more about what that is and how it's used to measure trends? Yeah, I can spend a minute with that for sure. Let's see here. If we go to this, let's go to here, and we'll say Intel. So an ADX is actually the indicator down here. The ADX line is actually derivative of DI, which is the directional movement index. This is one of the many indicators created by Wells Wilder. Wells Wilder created RSI, parabolic systems. Most technical indicators that you use most likely were based in some way on Wells Wilder, and that's not fair. There are plenty of other ones that were created. But the idea with ADX, by the way, is that it's a measure of trend. ADX stands for average directional movement. And the idea is this: in general, you look for when the ADX is above or below, usually the 20 or 25 range. I've heard arguments for both. And if the ADX line is below 20 to 25, like it was here in August, September, October of 2019, that tells you there is an absence of trend. It's not a trending market. It's more of a momentum-based market, more of a sideways market, more of a consolidation phase. When the ADX goes back above 20 to 25, that tells you it is a trending market. So a lot of indicators like moving averages are built more for trending phases than consolidation phases. So by looking for stocks with an improving ADX, it doesn't tell you which way the trend is going. It's simply a measure of trend. So in a big downtrend, you would actually see an ADX go up because it's telling you it's a strong trend. So a high ADX doesn't mean an uptrend, it just means a strong trend. So you would use things like the directional movement indicator or RSI or something like that to sort of qualify what direction it is. So if you screen for stocks with a low ADX, that will probably give you stocks in this sort of pattern, where it's more of a sideways pattern. If we have time down the road in another segment, I'll try to spend more time with that next week or beyond, but that's the basic idea of ADX, the average directional movement. By the way, any of those indicators like that, if you're not familiar with it, go to the chart school portion of the website. You can learn a lot more about it. We need to wrap the show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is the name exposure index and also the RIDEX flows. We didn't talk a lot about sentiment on yesterday's show, but I did want to point out that the RIDEX flows have gotten more and more, it's gone higher the last couple of days, which is actually coming off of a euphoric level. The RIDEX flows had been at the most bullish positioning ever, and this is inverted. So a low value or high here on the chart means investors are basically in the most bullish part of the RIDEX family. We've come off from that. So just like money managers have been tapping the brakes, you're seeing individuals tapping the brake as well. I think sort of recognized in the beginning of a potential deeper move, and certainly feeling to get more defensive. Chart number 2 is looking at pharmaceutical ETFs. I was looking at swing highs. A lot of pharmaceutical names came up in my screen for new swing highs, and I was drawn to create this chart. If you look year to date, 3 popular pharmaceutical ETFs. You have the IHE, which is the iShares ETF, up 0.8% during that same time frame. You have the XPH down 7%. And the PJP up 10%. So buyer beware, make sure you know what you're buying there. Finally, Intel, very interesting to see a stock bouncing off of its 200-day off of oversold conditions. I think a lot of charts like this, we talked about Facebook and Apple earlier in the week. I think a lot of charts are bouncing off of key support levels. I will be very keen going into next week to see if those hold. Folks, that is a wrap for this week. Have a fantastic weekend. For everyone here at StockCharts TV, I'm Dave Keller. Be safe. We'll see you on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.